What is it about the psychology of trading that prevents some people from moving on from a certain event? We've seen a lot of volatility recently, and it's those that adapt successful strategies that enable us to move through this and move on. Let's take a look now in some more detail about what's going on in many minds around the world that of those people that trade the markets. Ron William joined us, who's a behavioral psychologist and a trader, and he's been looking into this for us. Ron, explain the situation and how things presented to traders.
Yes, well, it's all rooted in the fact that our beliefs and values shape the behavioral reactions that many traders and investors will find themselves confronted with, especially in volatile times as we have experienced in 2020. So a great leading question to ask ourselves during such a time is, what does volatility mean to you? The three scenarios I tend to ask students of mine, but also many financial professionals that I interact with, is three options: risk, opportunity, or uncertainty. Risk, opportunity, or uncertainty. And really the answer to that question will give a good idea in terms of how we're likely to react from a strategy point of view, but also from a psychology perspective as well in current markets.
It's interesting, this 80-20 split comes across many different disciplines, and as you've got it here on the chart, it shows us precisely how the split is made: 80% beliefs and values and 20% results, behaviors. Explain more about this.
Yes, so it's the old 80-20 rule, which applies to most thinking systems, and it makes the point that what we think is controlling our results and our behavior is only the tip of the iceberg. So it only accounts for about 20%. So the overall key drivers to the behavioral decision-making process is actually underneath the surface level of the water. The so-called 80%, and that's the supercomputer program. Anything that is basically linked into what our beliefs are or values are about trading, risk, or money. And so the metaphor I'm using here is volatility, but of course it's anything to do with trading, risk, or money, which will really influence the way we do what we do as traders and investors.
And of course, moving on from this point, it's all about identifying and being prepared for the opportunity ahead. How best to illustrate this?
Yes, well, I mean, this is a very interesting and partly philosophical Eastern principle of crisis opportunity. And it was made famous in recent modern history by the US former President John F. Kennedy, when he actually said the Chinese use two brushstrokes to write the word crisis. Okay. One brushstroke for danger, the other for opportunity. And the key point here is, in a crisis, be aware of the danger, don't ignore it, but recognize the opportunity. So this is, word for word verbatim what John F. Kennedy, former US president, said at the height of the missile crisis of those times, for some of the historians who might know of that famous event. And this is all linking back to Eastern philosophy. I mean, I've been spending most of my time in Asia recently, where they have a deep understanding of duality, this double-sided nature to life and markets, and the old yin-yang balance of the two.
Let's move on and take a look at an example in terms of some of the trading experiences we've had in the past and identify periods of volatility and what people have been doing. Illustrate it for us to give us some sort of an example as to the patterns that have been emerging.
Well, it's really important for us to ground theory into practice, and I'm a big believer in doing that. And a chart that I've been really kind of pitching for some time now, ever since 2017, so some years, is this whole idea of volatility as a sentiment indicator, but also as a trading opportunity based on the VIX. So famously known as the fear index, we can see here that there are patterns in volatility, for those of you who want to track it, and I call them compression patterns, or some technicians might refer to it as a triangle pattern. But essentially, these are patterns of change. That's the behavioral side to the triangle or the compression patterns. And so we start with high volatility, we end with low volatility, and there's this constant high-low action-reaction, mean reversion in the markets and specifically in the volatility data such as the VIX. And it's really key for us to understand this. And part of the lesson from the chart that we're looking at on the screen right now is that many people make mistakes by being conditioned on previous data points and not adapting to the change. And this is what happened in 2015, 16, 17. At the end of 2017, when we finished a 3-year honeymoon period where markets were record highs, volatility was low, and we believed that central banks were the backstop to everything, the so-called fairy tale economy, people were crowding out, shorting volatility, and then the pain trade was the flip side to that trade, turned very ugly very quickly. In early 2018, we have the flash crash followed by various other volatility spikes. And of course, here and now, it's the COVID-19 spike that led to the GFC 2008 peak levels.
So what is it then about trader psychology that stops or prevents some people from moving on and adapting to this new era?
Yes, well, it's this era and past eras. History does rhyme in a behavioral sense. And really, Jeremy, to speak very honestly and authentically, it's all about the biology, how we're hardwired. Our brains are programmed for survival. So in a way, it's a catch-22, but I often say this problem has a solution. So the problem, let's focus on the problem initially so we can at least create some awareness for the audience out there, is we're designed to live and to survive, and that's a human species kind of end game design of the body. And so in times of stress, we tend to kind of focus on whatever survival strategy works. And in ancient days, that was, the caveman running away from a saber-toothed tiger, as you can see there on the screen. It was all about staying alive. Now we've got an ancient mind in a modern world, and this is the problem that most high-performance professionals, traders, and investors find themselves in, because it's no longer the tiger that we're running away from. Now it's loss aversion, or it's the digital information overload. It's the number of headlines we see about this whole pandemic and global shutdown, what it means for our business, what it means for our health, what it means for the economy. And so all of this is now adding an overload of chronic stress, not normal stress, chronic stress. And that creates the problem. And so I'm a big believer in actually turning the problem into a solution through a lot of behavioral work.
Ron, you've titled this presentation Seeking Alpha in a VUCA World. What is the VUCA paradigm?
Yes, so VUCA is originally a military term developed by the US during the back end of the Cold War. What it means is, what do we do when the world turns upside down? That's my own snapshot definition. And back when the US military coined the phrase, they were trying to fight a hidden enemy through new warfare tactics of proxy war, cyber attacks, terror attacks. It wasn't the old normal of head-to-head, tooth-to-tooth, boots on the ground type of military warfare. So many years later, business and finance professionals borrowed the term because they realized there's a lot of food for thought that we could learn from. And so it's now, how can we develop VUCA strategies for, and I'll define the acronym, volatility, uncertainty, complexity, and ambiguity. So it's not just volatility. It's what comes with the volatility when the world turns upside down and volatility is at record highs. And just to give an example there, let's look at the pandemic case in point. The uncertainty that came with the volatility, and certainly this whole shutdown situation, are we going to open up? When are we going to open up? And when we do, what will it look like? The complexity of the supply side shocks alone, which have really affected everyone. And then the ambiguity. We don't know what we don't know. So it's this constant wait and see mode, which affects not just our psychology, but also just our general strategies in the market.
Okay, so that's the VUCA paradigm, and you've taken it away nicely from the military into a sort of trading environment. What strategies should we bring on board to try and help us get over this point?
Yes, so I've given this a lot of thought, and when we've had markets like the equity market crash 30% in just a few weeks, oil below zero, negative for the first time ever in history, and VIX back at 2008 levels, we really got to ask ourselves the question, you know, what do we do now, and how do we change what we've been doing all this time? Something has to change. And so in this VUCA environment, change is required. And the three types of changes I really recommend to everyone to think about long and hard. One is resilience, two is divergent thinking, and three is optionality. And just to give a quick deep dive explanation of all three, resilience, we discussed this just recently in a live IG event, is all about the bounce back muscle. It's not about just being, hard as a rock and pretending that danger isn't there and volatility doesn't exist. It's about falling down and learning how to bounce back up from a strategy point of view, but also from a psychology point of view. So I always say it's a markets and mind focus. On the market side, we need to have an all-weather strategy, so one that works well during good and tough times. The hedge fund manager Ray Dalio is famous for developing the framework for an all-weather portfolio that does well through the different cycle seasons. That should have an active market timing element. That would be my proposition for current market environments. And that also will help mitigate the risk during such times. On the mind side, it's greater self-awareness, reduced behavioral bias, and an improvement on stress response management. That's the whole kind of brain biology problem which we just discussed. And then the last 2 points I just mentioned there: divergent thinking, probabilities not certainties, and optionality, multiple scenario planning. Let's look at the past anomalies, not the normal situations, but the abnormal situations, so we can be better prepared for what we don't know in this uncertain landscape.
Okay, Ron, look, thanks for joining us, talking us through these ideas that you have in order to make us all better traders. That's Ron William from RW Advisory.